Welcome to Clear Finance. I am James, your personal finance guide. Today we are diving into the world of low-cost investing to answer a classic question: index funds versus ETFs. Which should you choose? As global markets navigate a tense macro climate, driven by sticky inflation data and a highly cautious Federal Reserve holding interest rates higher for longer, building a resilient low-cost portfolio is more critical than ever. Both index funds and ETFs are phenomenal tools for this because they share the same index tracking DNA, mapping broad benchmarks like the S&P 500 to give you instant market exposure. But while their destination is identical, their structural paths differ significantly. Let's look at index funds first. An index fund is structured as a traditional mutual fund. When you buy shares in an index fund, the transaction executes once a day after the market closes, directly through the fund house. While they occasionally carry slightly higher expense ratios than their ETF counterparts, the trade-off is simplicity. They have no transaction or brokerage fees, making them incredibly straightforward for automated recurring investments. ETFs, or exchange-traded funds, on the other hand, trade exactly like individual stocks on an open exchange. This means their prices fluctuate second by second, and you can buy or sell them throughout the trading day. While ETFs generally boast lower management fees and superior tax efficiency due to their unique creation and redemption structure, they do introduce small frictional costs, such as the broker's bid-ask spread and potential trading commissions. To see how these minor differences compound, let's look at a hypothetical scenario. Imagine you are a freelance writer deploying $10,000 into a low-cost S&P 500 index fund, or a major ETF provider like Vanguard or iShares, charging an ultra-low expense ratio of just 0.05%. If the market returns 10% over the year, your investment grows by $1,000, minus a nominal $5 management fee. Now, if you chose an ETF tracking that exact same index, your annual management fee might be even lower, say 0.3%. However, if you are an active trader buying and selling that ETF frequently throughout the year, those recurring brokerage commissions and trading spreads can quickly add up, completely erasing your fee savings. Beyond ongoing fees, managing your tax burden is crucial for long-term wealth. For investors navigating the US market, ETFs hold a massive structural advantage here. Because of how they trade, selling an ETF rarely triggers capital gains taxes for the remaining shareholders. Index funds, by contrast, must occasionally sell underlying stocks to meet cash redemptions, which can pass an unexpected tax bill down to you. Speaking of taxes, here is a vital insider hack. Remain fiercely aware of the IRS wash sale rule. If you sell an index fund or ETF at a loss to lower your taxable income, but then buy a substantially identical security within 30 days before or after that sale, the IRS will disallow your tax deduction. Understanding this rule ensures you optimize your tax loss harvesting safely. As global citizens, our finances are constantly buffeted by external forces, from inflation and job market shifts to currency fluctuations. For instance, if you're planning a vacation to the United Kingdom next year, and the British pound suddenly strengthens against the US dollar, your trip becomes instantly more expensive. You cannot control currency swings or central bank decisions, but you can build a defensive shield. A globally diversified portfolio paired with a liquid emergency fund ensures that short-term macro noise never derails your lifestyle. Being dynamic with your money means shedding emotional attachment to your assets and treating your portfolio like a living organism. Review your strategy regularly, and don't be afraid to adjust your allocations when market realities shift. On that note, let's look at what our automated pipeline flagged this week. Our AI screened 25 high-growth US equities, and the top pick for this cycle is Snowflake Inc., ticker symbol SNOW, earning a multi-bagger score of 8 out of 10. Snowflake's explosive revenue expansion and robust enterprise adoption drive serious long-term upside, though a lack of recent insider buying remains a notable risk. Remember, this is automated data screening, not formal financial advice. Always conduct your own deep research. To lock down your financial foundation this week, implement these 3 actionable tips immediately. First, audit your emergency reserve. Ensure it holds at least 3 to 6 months of living expenses completely liquid to buffer against macroeconomic uncertainty. Second, rebalance your asset allocation. If recent tech runs have overconcentrated your portfolio, trim those high-risk peaks and reallocate the capital into